right now, I mean, literally right as we're talking, algorithms in some New York server farm are forcibly liquidating millions of dollars of digital assets.
Yeah.
And the crazy part is they are doing it entirely because of these super fragile peace talks happening thousands of miles away at this heavily guarded hotel in Islamabad.
Right. It's wild.
We are literally watching physical world conflicts instantly and violently reprice decentralized digital networks. So welcome to the week that was. You are here because, well, you want to understand the massive structural shifts happening in the global economy right now.
Exactly.
You want to cut through the noise, and that is exactly what we are going to do today. Our mission here is to look strictly at the mechanics of how global conflicts, macroeconomic forces, and institutional wealth are just colliding in real time.
Yeah, because, the transmission mechanism between a kinetic military event and a digital price swing used to take days. Like, human traders had to actually sit down and digest the news.
All right.
But now, it happens in milliseconds. So today, we're going to map out exactly how that works. We will unpack the physical chokeholds that are currently squeezing global energy, and then analyze how automated trading algorithms actually process all that geopolitical chaos.
Yeah, and then we're going to look at the quiet structural takeover of the digital asset class by traditional wealth managers.
Which is a huge shift.
It really is. And finally, we will examine the physical security of the network itself, like looking at the actual machines securing these trillions of dollars. But let's start by looking away from the screens for a second and just focusing on the physical world.
Always a good place to start.
Right. Because the catalyst for all the digital volatility we are seeing is actually sitting in Islamabad. The Serena Hotel has effectively been turned into a fortress.
Yeah, a literal fortress.
We are talking about a staggering security presence, like 10,000 police officers, total military control of the perimeter, all just to host ceasefire negotiations between the United States and Iran.
And, well, while diplomats negotiate inside that heavily fortified bubble, the reality on the ground, and particularly on the water, is severely degraded. I mean, diplomacy is actively breaking down into kinetic action.
Yeah, things are escalating fast.
Right. We've observed targeted strikes on Iran's Karg Island. And just to understand the gravity of that, Karg Island manages 90% of Iran's entire crude oil export capacity.
90%, wow.
Yeah, it is basically their economic lifeline. And we've also seen the degradation of the South Pars petrochemical complex alongside the execution of what Israeli forces designated as Operation Eternal Darkness in Lebanon.
And the retaliation didn't even wait. I mean, we saw a barrage of ballistic missiles and drones trigger massive fires at Saudi Arabia's Al Jubail industrial city.
Right.
And that isn't just a factory, right? That one complex generates 12% of the kingdom's entire gross domestic product.
Which is staggering. But, the true choke point, the place where all this localized conflict spills directly into the global economy, is the Strait of Hormuz.
Okay, let's unpack this. Because the Strait of Hormuz is essentially the global economy's jugular vein, right?
That's a perfect way to put it.
If it gets squeezed, inflation is basically the unavoidable symptom. So what is actually happening in the strait right now?
Well, the strait is under a functional blockade. We are tracking reports of the waterway being actively remined, which makes transit a massive physical risk.
Right.
To put the logistics of this blockade into perspective, you usually have an average of 140 commercial vessels transiting that narrow corridor on any given day.
And now?
Now, that number has plummeted to single digits.
Oh, wow.
Yeah. There are over 600 commercial ships just sitting there, stranded, unable to move forward or backward.
And I saw we're getting verified reports of Iranian forces demanding transit tolls approaching like $1 million per vessel.
Literally $1 million. Yes.
Which effectively halts 20% of global oil consumption. So when that flow of energy stops, the macroeconomic impact is just immediate. Brent crude oil has spiked to peaks of $111 per barrel.
Right.
And as a direct result of that energy shock, headline inflation in the United States has rebounded, hitting 3.3%. But, explain why this specific type of inflation traps the central banks. Why can't they just cut interest rates?
Well, if we connect this to the bigger picture, the mechanism behind that inflation is what creates a massive structural trap for the entire central banking system.
Okay.
Because the Federal Reserve doesn't just look at a generic price tag, right?
Right.
They track the Core Personal Consumption Expenditures Index,
Yeah.
or the PCE. So when oil spikes, transportation costs spike, manufacturing costs spike, and the PCE goes up, This is a classic supply-side shock.
Meaning, the inflation isn't happening because everyone suddenly has too much money and wants to buy a new car.
Right.
It's happening because the physical cost of moving that car from the factory to the dealership just doubled.
Exactly. It's the cost of goods, not the demand for them. Central banks have tools to cool down an overheating economy, right? They raise interest rates to make borrowing expensive, which crushes consumer demand.
Sure.
But they cannot print oil. They cannot lower the cost of marine insurance for freighters in the Middle East.
Right.
So if central bank governors try to stimulate a slowing economy by, say, injecting liquidity or cutting interest rates while supply-side inflation is raging, they risk triggering hyperinflation.
Oh, wow.
Yeah, so they are legally and functionally forced to hold rates high. The physical war guarantees a restrictive monetary posture.
Which means the era of cheap borrowed money is officially on pause.
Exactly.
And for digital assets like Bitcoin, that creates a really unique environment. I mean, they cannot rely on a flood of cheap fiat currency entering the system to pump the price up. They have to rely entirely on organic demand.
Right.
But knowing that the Federal Reserve is trapped and seeing this widening global conflict, I mean, intuition suggests we'd see a traditional market crash,
Right.
investors moving to cash, right?
That's what you would expect, yeah.
But instead, we are watching this mechanical, algorithmic meat grinder in the digital asset markets. Bitcoin is acting as this real-time pricing mechanism for geopolitical uncertainty, violently swinging between $67,000 and $73,000, based purely on rumors coming out of those Islamabad ceasefire talks.
Yeah, and we really have to look at the market microstructure to understand why this volatility is so mechanical.
Okay.
So human traders were reading the news, right? Looking at the blockaded strait and assuming military ultimatums would inevitably crash the price. So they accumulated short contracts.
They essentially borrowed the asset, sold it at the current price, and hoped to buy it back cheaper later to pocket the difference.
Exactly. But the machines had a completely different plan.
Here's where it gets really interesting.
Yeah, because when news of the ceasefire framework broke across global wires, the market didn't slowly, rationally digest the news.
Yeah.
Automated margin engines and high-frequency trading algorithms instantly recalibrated.
It's like, think of these algorithms like heat-seeking missiles. They don't read the news. They don't care about the geopolitics. They are just programmed to hunt localized pockets of vulnerability.
Exactly. Specifically, the stop-loss orders placed by those short sellers.
Right, and they just hunt those clusters to force liquidations. But how does this synthetic liquidity actually differ from actual organic human buying?
Well, when a short seller's position starts losing money because the price ticks up on good news, the exchange's automated margin engine basically steps in.
Okay.
It forces them to buy the asset back to cover the loss. The algorithms execute market buy orders to cover those underwater short positions. And this creates what we call a synthetic bid.
Let's clarify what a synthetic bid actually is, because it's a crucial concept.
Yeah, it's super important.
If I go out and buy a digital asset because I believe in its long-term value, that is organic demand. I am voluntarily choosing to buy.
Right.
A synthetic bid is compulsory. The short seller is forced by the exchange's software to buy back in, regardless of the price, just to close their position and prevent the exchange from taking a loss.
And because that automated system is buying at literally any price, it consumes all the asked liquidity on the order book.
Which is just a list of everyone waiting to buy and everyone waiting to sell.
Exactly. So when those forced buy orders chew through all the available sell orders, the price violently skyrockets. We saw a resulting liquidation cascade where centralized exchanges processed over $873 million in forced margin closures in a single reporting window.
$873 million. That's insane.
Yeah.
I mean, there was a single $25.8 million liquidation event just on the hyperliquid decentralized exchange alone.
Right. One trader.
One trader or one entity completely wiped out in an instant. But because this massive price spike is driven by algorithms forcing people to buy, it must feel incredibly hollow underneath.
It is entirely hollow because it lacks deep, fundamental bid-side support, meaning there aren't enough organic buyers placing limit orders below the current price to catch it if it falls. The market remains highly vulnerable to a sharp retracement.
Right, so if those diplomatic negotiations in Islamabad fail,
the short covering volume immediately dries up and gravity takes over. The algorithms are just forcing price discovery upward through liquidations, not true foundational accumulation.
So while the algorithms are basically chopping up short-term traders on the surface, there is a massive, quiet shift happening deep in the foundational ownership of the asset.
Absolutely.
We are seeing a complete divergence in institutional behavior, and we know this because of the 13F regulatory filings, right?
Yes.
For those who don't know, these are the mandatory reports that institutional investment managers who manage over $100 million must file, basically disclosing their holdings.
And the 13F data reveals a stark contrast in strategy based on time horizons. Well, on one side, you have macro hedge funds, massive entities like Brevin Howard and Farallon Capital. They have drastically slashed their exchange-traded fund positions, some reducing their exposure by up to 85%.
85%, wow.
Yeah, their mandate is often based on quarter-to-quarter performance metrics. So they are executing distribution protocols to lock in fiat liquidity amid all the geopolitical panic.
So they are playing a day trader's game. They're basically renting the asset to catch a quick price swing, and when things get scary, they dump it.
Exactly.
But on the exact opposite side of the spectrum, sovereign entities like the Emirate of Abu Dhabi and traditional wealth management platforms are expanding their aggregate holdings by 145%.
That's a massive accumulation.
I mean, you have corporate treasuries like Strategy Inc. executing a $329.9 million acquisition, grabbing 4,871 Bitcoin at an average price of roughly $67,700.
They are entirely ignoring the short-term algorithmic noise because their time horizon is measured in decades, not reporting windows.
Exactly. They aren't renting the asset. They are pouring concrete foundations to own it permanently.
Yeah.
And the massive catalyst for this concrete pouring seems to be Morgan Stanley. They just became the first Wall Street commercial bank to directly sponsor a spot ETF, the MSBT.
Which is huge.
And they launched it with an incredibly aggressive 0.14% management fee, severely undercutting massive competitors in a race to the bottom for fees.
Right, the fee war is interesting, but the real structural shift is their distribution network. Morgan Stanley has 16,000 wealth advisors managing trillions in client capital.
Trillions.
Yes. And internal compliance rules now permit these advisors to allocate up to 4% of client portfolios directly into digital assets.
Okay, I want to map out the mechanics of this because it's massive. What happens to the underlying market dynamics when you have 16,000 advisors funneling traditional capital and draining this much supply into institutional cold storage?
It fundamentally alters the aggregate supply elasticity of the asset.
Meaning, basically, how responsive the available supply is to a sudden change in price.
Correct. What you are witnessing is a structural transfer of ownership from retail participants to institutional fiduciaries.
Right.
When these wealth managers buy on behalf of clients, the coins are essentially locked in a regulated vault. They are removed from the liquid float, the portion of the asset actively available for daily trading.
Okay.
So as the liquid float drains into cold storage, the ask-side order books just thin out.
So there are simply fewer coins sitting on exchanges waiting to be sold.
Exactly.
Which means that once the macroeconomic headwinds, like the supply side inflation from the oil shock we talked about, eventually subside, there will be minimal resistance for future price discovery.
Precisely. A relatively small amount of organic buying pressure will move the price significantly higher because the available supply is so incredibly constrained by these institutional vaults. The supply shock is basically being engineered in plain sight. But institutional capital requires a regulatory framework to operate within. They cannot pour concrete without building permits.
Which brings us to the regulatory fences being built around this ecosystem. Wall Street is locking up the supply, but depending on where you live, these new rules are either opening massive institutional doors or they are literally pulling up the ladders on everyday people.
Yeah, it's very fragmented.
Let's look at how the rules of the game are suddenly changing globally.
Well, we are observing a highly fragmented global regulatory approach, rapidly transitioning from an era of attempting to ban the asset to an era of capturing it.
Right. In the United States, the Department of Labor has proposed a rule creating a safe harbor for fiduciaries to include digital assets in the 401k defined contribution market.
Which is massive.
We're talking about a $10.1 trillion pool of retirement capital suddenly getting a green light.
Yeah. And meanwhile, the U.S. Senate is preparing to classify Bitcoin as a digital commodity, which officially transfers oversight to the Commodity Futures Trading Commission.
CFTC.
Right, and that commodity designation is the holy grail for enterprise treasuries and commercial banks. It provides the legal clarity necessary to confidently hold the asset on corporate balance sheets.
Although it's worth noting the government is also heavily policing the space, right?
Absolutely.
I mean, they are cracking down hard on insider trading in prediction markets like Polymarket, particularly after individuals attempted to front-run the Islamabad ceasefire news using insider diplomatic knowledge.
Yeah, they are making examples of people.
And we see a similar wave of legitimization in Asia. Japan's cabinet just approved a bill officially classifying crypto as financial instruments.
Right.
And they paired it with a massive tax incentive, dropping the rate from a punitive 55% down to a flat 20% capital gains rate.
Which is huge for adoption.
Yeah, that is a neon sign flashing institutional capital welcome here. But then you look at the United Kingdom, and the picture is completely different.
Yeah, the UK regulators enacted a highly restrictive policy. They removed crypto exchange-traded notes, which are basically unsecured debt securities that track the asset's price from tax-advantaged individual savings accounts or ISAs.
So they essentially forced everyday retail investors out of tax-free compounding environments and into taxable general investment accounts.
Exactly.
I mean, brokerages like Trading 212 literally had to disable the buy button for these assets for their retail clients.
Yeah, they just turned it off.
I have to push back on the narrative we often hear about universal global adoption. Looking at the UK, it feels exactly like pulling up the ladder for everyday retail investors right at the exact moment Wall Street is getting VIP tax advantage access.
Well, what's fascinating here is the underlying motivation. It's critical to understand.
Okay.
Governments globally are categorizing digital assets to integrate them into their traditional tax frameworks.
Right.
This integration legitimizes the space, sure, but it drastically alters the access points. Institutional rails are being lubricated, while retail rails in certain jurisdictions are being intentionally restricted to funnel capital through easily taxable legacy environments.
Wow.
Yeah, it's no longer about whether the asset survives, it's about who gets to toll the road.
Which brings us to the physical foundation of the network itself.
Yes.
With trillions of dollars of traditional capital migrating into this space and governments scrambling to capture the tax revenue, the physical security of the decentralized ledger is more critical than ever. We have to look at the machines that actually run the consensus algorithms.
Right, and the physical reality of mining is deeply intertwined with the kinetic conflicts we discussed at the top of the show.
How so?
Well, when those military strikes hit Iran's infrastructure, it severely disrupted their national energy grid. And as a direct result, Iran's sovereign mining capabilities basically collapsed. Yeah, their aggregate hash rate, the total computational power they contribute to securing the network, plummeted by 77% almost overnight.
So state-sponsored mining in conflict zones is incredibly fragile.
Ultimately.
But corporate mining, operating in stable jurisdictions, is becoming ruthlessly efficient. I mean, BitDeer just launched their SealMiner A4 series, and the specifications are wild.
Yeah, they really are.
They are achieving an efficiency of 9.45 joules per terahash. To break that down, a joule is just a unit of energy, and a terahash is a trillion calculations per second.
Right.
To perform a trillion cryptographic calculations using that little energy is an absolute engineering marvel.
It is, and that thermodynamic efficiency is vital for their profitability. But we're also seeing these mining entities smartly diversifying their revenue models.
Oh, like leasing to AI developers.
Exactly. They are actively leasing their secure, high-uptime energy infrastructure to artificial intelligence developers. They are bridging the gap between digital asset mining and AI compute to secure predictable fiat cash flows, regardless of the asset's price volatility.
That's incredibly smart. Now, amidst all this massive industrialization, there is always this persistent rumor that surfaces the quantum threat.
Ah, yes.
The idea that a quantum computer is going to suddenly boot up, break the network's cryptography, and steal all the funds. But research from BTQ Technologies just thoroughly debunked this.
Yeah, they really did.
They analyzed what it would actually take physically to use a quantum computer to execute the SHA-256 consensus algorithm, which is how the network validates blocks.
And the results of that research are just staggering. The quantum threat is physical fiction in the near term.
Right. To do it, they calculated you would require 10 to the power of 25 watts of energy.
Which is insane.
That is the literal power output of a star. Worrying about quantum computers hacking the network's consensus is like worrying about an alien invasion while leaving your own front door unlocked.
Exactly.
The real risk isn't some sci-fi supercomputer breaking the global ledger. The risk is individual wallet security.
Yes.
It's vulnerabilities in the elliptic curve digital signature algorithm, the ECDSA, which is the specific cryptography that secures your private keys, not the network's hashing algorithm.
You're totally right. The network consensus itself remains incredibly secure and resilient. And we actually got a beautiful proof of concept regarding that decentralization in this reporting window.
Oh, right, the solo miner.
Yeah. Despite the deployment of massive corporate mining fleets and the AI energy wars, a solo miner operating with just 230 terahashes successfully validated a block.
Just one single person plugging a machine into a mining pool, beating 1 in 28,000 odds to win a block reward valued at over $210,000.
It's amazing. And it proves a critical point about the architecture. Despite the influx of Wall Street capital and government oversight, the fundamental decentralized consensus mechanism remains fully accessible.
Right.
A non-industrial participant operating outside of a server farm can still cryptographically validate the global ledger and secure the network.
So let's summarize the landscape we have just mapped out. We are navigating an incredibly complex environment where physical, kinetic conflicts in the Middle East are directly dictating global energy prices.
Yeah.
Those energy prices are creating supply-side inflation, which structurally traps central banks into maintaining high interest rates.
Exactly.
And all the while, beneath the surface volatility of automated margin engines liquidating short-term traders, Wall Street wealth managers and sovereign wealth funds are quietly pouring concrete, absorbing the remaining liquid supply of digital assets.
It is a profound structural shift playing out 24/7 across the globe.
Which leaves me with one final provocative thought for you to mull over. Digital assets were originally engineered to be the alternative to the legacy financial system.
Right.
They were built to bypass the middlemen and the institutions. But if traditional finance successfully captures and wraps this asset inside 401k, inside legacy banking apps, and massive wealth management portfolios, does the ultimate decentralized asset paradoxically become the ultimate centralized financial anchor for the legacy system itself?
Wow.
Have we just built a new, unhackable foundation for the very institutions it was designed to bypass?
That might just be the defining financial paradox of our time.
Thank you for joining us on this deep dive into the week that was. Keep questioning the mechanics behind the headlines, look past the algorithmic noise, and keep learning. We will see you next time.